Welcome back to the Daily Crypto Deep Dive. If you've been in crypto for more than one cycle, you've probably noticed something that doesn't quite make sense at first glance. The infrastructure today is stronger than it has ever been. We now have spot Bitcoin ETFs approved in the United States. We have major asset managers like BlackRock and Fidelity offering regulated exposure. We have clearer regulatory frameworks emerging. We have stablecoins moving billions of dollars daily. We have institutions building custody solutions, compliance rails, tokenization platforms, real-world asset integrations, and corporate treasury allocations. And yet, most altcoins are still trading significantly below their previous cycle highs. Some are down 30%, others 60%. Many are still 80 or even 90% below their 2021 peaks. So the obvious question is this: if crypto infrastructure is stronger than ever, why are altcoin prices weaker than before? To understand this properly, we have to separate infrastructure from liquidity. Infrastructure is the plumbing, liquidity is the fuel, and price is what happens when liquidity flows through a narrative at scale. What we are seeing right now is a market where the plumbing has improved dramatically, but the fuel is being concentrated in one area, Bitcoin, rather than spreading across the broader altcoin ecosystem. The first structural reason altcoins are lagging is liquidity concentration. The approval of spot Bitcoin ETFs changed the capital flow dynamics of the entire industry. For the first time, traditional investors could gain exposure to Bitcoin without self-custody, without exchanges, without seed phrases, and without technical friction. Capital that might previously have flowed into exchanges and then trickled into altcoins is now being captured at the ETF level. When billions of dollars enter a Bitcoin ETF, that money buys Bitcoin directly. It does not rotate into layer 1s, DeFi tokens, gaming coins, or experimental protocols. It goes straight into BTC custody accounts. This has pushed Bitcoin dominance higher relative to much of the previous cycle's alt-season environment. In 2021, retail-driven liquidity flowed broadly. In this cycle, institutional-driven liquidity is flowing narrowly. And that shift matters. Institutions are structurally conservative. They allocate to assets with the highest liquidity, the strongest regulatory clarity, and the lowest relative risk within a category. In crypto, that asset is Bitcoin, occasionally Ethereum, rarely beyond that. So while infrastructure has matured, the type of capital entering the space has changed. It is less speculative and more allocation-driven. And allocation capital does not chase small-cap altcoins aggressively. The second reason altcoins are under pressure is the explosion of supply. In the 2020 to 2021 cycle, there were significantly fewer liquid tokens competing for attention and capital. Today, the number of tokens has multiplied dramatically. Venture capital funding during the low-rate era led to hundreds of projects launching with large token supplies and aggressive unlock schedules. Many of these tokens are still releasing supply into the market through vesting events. Even when demand increases modestly, ongoing unlock pressure can suppress price appreciation. If a project has $1 billion fully diluted valuation but only a small portion circulating, then as new tokens unlock each month, that creates structural sell pressure. Infrastructure might improve, adoption might grow slowly, but token supply expanding faster than demand will cap price. And this isn't just theoretical. On-chain data shows billions of dollars in token unlocks scheduled across multiple altcoins over the coming years. In previous cycles, retail demand was strong enough to absorb unlocks through speculative enthusiasm. Today, demand is more measured. Without retail mania absorbing supply, unlocks weigh heavier on price. Which brings us to the third factor. Retail participation is not back at full strength. The 2021 bull market coincided with stimulus checks, lockdown savings, low interest rates, and a global appetite for risk. Meme stocks exploded. NFTs went mainstream. Crypto exchanges saw record app downloads. Today, the macro backdrop is different. Interest rates remain higher than in the stimulus era. Cost of living pressures are real. Disposable income is tighter. Retail speculation has not returned at the same intensity. Institutions may be buying Bitcoin, but altcoins historically thrive on retail risk appetite. When retail sentiment is cautious, Altcoins struggle to gain momentum. We can see this in search trends, exchange activity, and funding rate dynamics. Retail-driven euphoria tends to show up in meme coin explosions, parabolic social engagement, and rapid rotations between sectors. What we have now is more selective speculation, rather than broad, irrational exuberance. And altcoin seasons historically require broad enthusiasm, not isolated interest. There's also a counterintuitive dynamic at play. ETF success may actually be suppressing altcoin performance. Before regulated ETFs, investors who wanted crypto exposure often bought into exchanges directly. Once on exchange platforms, capital frequently explored multiple tokens. Some portion flowed from Bitcoin into Ethereum, then into mid-caps, then into smaller alts. That rotation dynamic fueled alt seasons. Now, a large share of new capital never touches the exchange ecosystem. It sits inside brokerage accounts and ETF wrappers. That capital is effectively removed from the altcoin rotation cycle. It's exposed to crypto, but only to Bitcoin. So paradoxically, institutional adoption has strengthened Bitcoin while potentially reducing speculative capital flow into altcoins. Another structural shift is market maturity. In earlier cycles, price discovery was chaotic and inefficient. Smaller order books allowed relatively modest inflows to create extreme price swings. Today, derivatives markets are more developed. Perpetual futures volume often exceeds spot volume. Market makers hedge quickly. Arbitrage spreads close rapidly. Volatility still exists, but explosive multi-month altcoin runs require sustained spot inflows, overwhelming derivative suppression. Without strong spot demand, derivatives can dampen upside momentum. Then we have narrative fragmentation. In 2021, narratives were clean and powerful. DeFi, NFTs, metaverse. Each theme captured mass attention and drove concentrated capital flows. Today, narratives are more fragmented. Artificial intelligence tokens, real-world asset tokenization, modular blockchains, layer 2 scaling, gaming ecosystems, restaking protocols, meme cycles, infrastructure tokens. Capital is divided across many sub-themes rather than focused into one dominant story. Fragmentation dilutes momentum. When attention splits, price impact per sector weakens. There is also a valuation reset taking place. During the previous cycle, many altcoins reached extreme valuations based largely on growth projections, rather than realized revenue or usage. As markets mature, investors become more selective. Tokenomic scrutiny has increased. Projects with high emissions, unclear utility, or weak revenue models are repriced lower. Infrastructure development does not guarantee token appreciation. In fact, infrastructure progress can highlight which tokens capture value and which merely facilitate network usage without strong accrual mechanisms. Another overlooked factor is stablecoin dynamics. Stablecoins have grown significantly, but much of that liquidity circulates within decentralized finance or cross-border settlement systems, rather than directly into speculative altcoin accumulation. Stablecoin market cap growth does not automatically equal altcoin buying pressure. Stablecoins can represent capital waiting on the sidelines or used for yield strategies rather than directional bets. Macro environment also plays a role. Liquidity conditions globally are tighter than during the quantitative easing era. Even if crypto infrastructure has matured, global liquidity still drives risk asset performance. When central bank policy tightens or remains restrictive, high beta assets like altcoins feel pressure first and strongest. Bitcoin, increasingly perceived as digital gold, may attract relative safety flows within crypto during uncertain macro periods, further widening the performance gap. Let's also consider capital efficiency. In previous cycles, many investors chased altcoins because Bitcoin had already made large moves and they sought higher percentage gains. Today, Bitcoin ETFs provide leveraged exposure opportunities through traditional markets, options, and structured products. Investors can express bullish views on Bitcoin through multiple instruments without rotating into smaller tokens. That reduces the necessity of altcoin exposure as a performance enhancer. So, where does that leave us? It leaves us in a market where infrastructure strength does not automatically translate into broad altcoin strength. Infrastructure is foundational. It lowers barriers. It increases legitimacy. But price acceleration requires liquidity concentration, narrative dominance, and risk appetite alignment. At present, liquidity concentration favors Bitcoin. Narratives are fragmented. Retail enthusiasm is cautious. Token supply remains high. Derivatives markets dampen excess volatility. And macro liquidity is not explosively expansionary. However, this does not mean altcoins are structurally doomed. In fact, the current environment may be building compression. When supply unlocks slow, when retail participation increases, when macro conditions loosen, and when one narrative captures broad imagination again, altcoins could move aggressively due to thinner spot liquidity relative to past cycles. The difference is that the trigger conditions must align more precisely than before. The key takeaway is this: altcoins are not lower because crypto has failed. They are lower because crypto has matured. Institutional capital behaves differently than retail mania. Mature markets price risk more selectively. Supply matters more. Liquidity matters more. And narratives must be stronger to drive outsized returns. If we eventually see interest rate cuts, expanding liquidity, renewed retail engagement, and ETF products broadening beyond Bitcoin into multiple altcoin categories, then capital distribution could change. But until then, Bitcoin remains the primary liquidity magnet. Altcoins remain leverage plays on broader market optimism. And infrastructure growth, while critical long-term, is not a short-term price catalyst on its own. So the next time someone asks why altcoins are still down despite stronger infrastructure, the answer is not confusion. It is structure. Capital flows have changed, supply dynamics have changed, market maturity has changed, and until liquidity, narrative, and risk appetite converge again, altcoins will likely continue to lag the asset that institutions trust most. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.